Welcome back, everybody, to episode 3 of the Finance Operators. I'm here with my co-host, Mehtab. How are you doing, Mehtab?
Good. How are you?
I am great.
Where are you?
I'm in sunny Austin, Texas right now. So my cold Midwest bones are thawing out after a long winter in Chicago. We have a lot on the docket. It's been an exciting couple of weeks in the industry. We've got 23andMe that filed bankruptcy, Chapter 11, after a pretty incredible run. We're going to talk a little bit about the Saratoga Water guy and why, they may or may not have sort of blown their opportunity there. We are also going to cover Pura Vida. So that's going to be the meat of our conversation today. One of the classic D2C darlings, a true, fall from grace. It seems like a lot of our coverage kind of involves bankruptcies these days, but essentially, they were sold off for pennies on the dollar after being acquired. And then we're also going to get into the grungy tariffs and how to defeat those. So give us a quick preview on that one.
We're going to help you crush COGS. You should be able to walk away with at least one or two things that you can try out. Crush those COGS and juice your EBITDA, win back some of that margin that you're losing because of tariffs. So yeah, let's jump into it.
We had a packed agenda. We actually trimmed it a little bit. So what we are going to talk about is I want to touch on the whole Saratoga Water thing because I think it's pretty hilarious. And there was a big merger between these companies last year that I don't think anybody really talked about. So it's interesting context. And then I want to dive in a little bit to Pura Vida. So I think everybody's kind of aware at this point that Farrah Bradley has sold up, effectively divested the brand entirely. Well, not effectively, definitely entirely, for about $1 million. So I want to dive into that story. And then I want to get your grungiest takes on how to deal with tariffs. So give me a quick preview on that one.
Yeah, so we're hopefully by the end of the episode, you'll have at least one or two things that you can walk away with and use to negotiate down your costs, specifically associated with COGS, and counteract some of those disgusting tariffs.
So on the sort of primo brand Saratoga Water thing, like I assume that you're sort of up to speed with this if you spent a minute on Twitter this week. Can you give us the quick rundown on exactly what happened or is going on here?
Yeah, so basically this fitness influencer posted a video involving Saratoga Water, a banana, ice water, faux balcony squats, and a few other things. And when I say it that way, it sounds like something really bad, but it's actually pretty funny. It's safe to watch at work. So
yes, it's basically just like this guy, and I have seen his content months ago because he's pretty Instagram famous. I think he had probably 5 million followers or something before this whole thing. And it's one of those things where you see it on your feed and you can't scroll past it because you're just what the actual hell is this kind of a thing. And then so it went super viral over the course of this week. And what I thought was really, really fascinating and I want to kind of get your take on is people were basically saying they're blowing it, they're not seizing their moment. And I think there's a little bit of context to that. So the first one is they don't sell online, right? So it's not really the same exact thing as when your e-commerce brand goes super viral. They're also part of a company that does $5 billion in sales. So it was in November of last year, the Primo Water Corporation and Blue Triton Brands did a stock for stock merger effectively at $9 billion.
How much revenue does Saratoga do?
It's not exactly in the filings, but they say 70 million or so out of 5 billion.
Well, it's smaller than I thought. I actually would have thought it was bigger. I've definitely heard of it before, and
I really like it. I've been to Saratoga before, and it's actually really popular in Saratoga, in New York. This company owns Ice Mountain, Polar Spring, Mountain Valley, and then in Saratoga. So they do $5 billion of revenue. So I don't want to harp on this whole thing too much, but to me, they didn't blow anything. They got a nice little boost in the Twitter sphere for one of their smaller, properties. But I want to get your take in terms of should they have handled that differently, or do you think that they capitalized on it properly?
I think they actually ended up posting a bunch of stuff related to it. But like you said, it's harder to capitalize on something if you're not an e-commerce native brand, right? If you're selling largely through retail channels, just not in your DNA, it's probably not going to happen. It's not really going to move the needle all that much anyways, relative, again, like you said, if it was something that was e-commerce heavy, inherently set up to capitalize on it. So yeah, I don't really blame them. And I don't honestly feel it would have moved the needle too much anyways.
And that's kind of all I wanted to touch on is like everybody listening to this, like they didn't really blow it. Like they weren't going to like ramp their meta ads or increase their cost caps or whatever. Like it wasn't like that. Like they're playing in an entirely different ball game. And they did end up kind of posting about it, but it's like a $12 billion company or something. So it's not exactly like they can just kind of do that. But neither here nor there, I suppose. I think the meat of what I want to talk about is kind of in relation to the Pura Vida story.
Should we start with the background? Where do you want to start?
Yeah, I want to get the story because I don't know if you're familiar with it or not, but they're like kind of in my mind in like the class of like the absolute darlings of D2C.
Yeah, and whatever I think of Pura Vida, what I think of is we used to go to their website all the time, I think 2017 and 2018, to find CRO ideas and just rip them blatantly. They were kind of like, I feel like right now everyone rips from Ridge and they rip from, like Ridge is kind of the one a lot of brands you'll see just try to rip from on the CRO side. But Pura Vida was like the go-to brand that everyone would go look at their site and just try to find cool concepts to test. And you'd see them on every Shopify case study. You'd see them like anything related to SaaS and Shopify, you would see them featured. It would be like the logo to have if you were a SaaS vendor. And there would always just be tons and tons of case studies everywhere about them. So that's how I know about them.
And do you know kind of like the story of how they started and all that?
No, walk me through it.
So these guys were early, like they were like pre-Shopify kind of a thing. And so the guy's name is Griffin Thal, and then Paul Goodman. So these guys, they were roommates at San Diego State, and they seem to be very, very close friends still. And so they went to Costa Rica for a trip, and they essentially like found these local artisans that were selling these like nice, cool, colorful bracelets. And they basically just like brought it back to the States because they were like, this is a super cool idea. We think that we can build a brand sort of on, the idea that like this is a socially conscious, like we support these sort of artisanal communities of these people. And that's really sort of the ethos of how it started. And they said, I listened to a podcast interview with Griffin Thal, and he basically said that like they did a really early partnership with Lauren Conrad, who was like, do you know who that is? I forget what show she was on.
Don't.
She was like 2012's peak, like it was like the Gossip Gilmore Girls or like something like that. Some like famous.
One of your favorites.
Yeah. Some like famous girl they did a partnership with, and they paid her $8,500, and it kind of blew up. And then they really credit their ability to capitalize using lookalike audiences back in like 2012 on how they scaled the brand based off of that influencer promotion. So they were the first brand to get to 1 million followers on Instagram. I think they were the first brand to get to 2 million followers on Instagram. And so like to your point, like really, really famous company. They ended up getting to about $65 million in sales in 2019 when Vera Bradley bought 75% for $75 million.
Wow.
So it was about like a 1.5x on like their top line. And I've seen like some like mixed reports. It was like $100 million valuation or like 130. There might've been like some movement with relation to like the earnout or something that they actually ended up paying. But then Paul and Griffin, they end up selling their remaining 25% only a couple of years ago. And I don't know if you saw this, but I found a LinkedIn post from Paul that is about a year old, and he said, "It says today my former company Pura Vida let go of the first employee that we hired 13 years ago. How to ruin culture 101 is like the short version." And so he kind of previewed like this downfall. So I have my own sort of thoughts or opinions here, but what do you think went wrong?
Yeah, I feel like that was a very marketing driven company without much of a product moat. Again, you can almost think of it as like fashion, right? And if you lose your main merchandiser / product person, things get really difficult. But with that company specifically, it's the marketing side. You have to be on the bleeding edge, right? And that relatively low AOV, I mean, the products are just very cheap bracelets and you can't really push them past a certain price point. So when I know they had a lot of issues post iOS, which makes sense to me. Like if you're on the lower side of AOV, it's really hard to outrun the Facebook CAC monster, especially if you're Facebook heavy or Meta. And supposedly, like I've heard from a few people they had issues around. Obviously, they had some issues around efficient customer acquisition, but I think it's hard to get around that if you don't have a founder and you're still a relatively small brand. It's not like they're doing $300 million a year or something where they could afford like a crack team of executives. Probably just didn't have the right people to tackle the CAC issue.
And that's basically what Vera Bradley has said, and they've said it over the course of several quarters. And so they break out Vera Bradley's sort of reporting segments is like Vera Bradley and Pura Vida. So they're very transparent about the performance of both segments. And so just to give you like a few numbers here, 2019, the year that the brand was acquired, 65.9 million in sales. The next year, 112 million. So they basically almost
that was
doubled.
COVID though, right?
Yeah, I guess so. Yeah, that's right. And then 2021, 120 million. So moderate growth. And 2020 and 2021 were like $8 and $10 million in operating income respectively. So they weren't really profitable before the acquisition. So I actually thought it was like decently priced. Like they bought it for 100 million effectively. And the next year it does 8 million in operating income. Like that's, on its way to being a pretty successful acquisition. Or maybe I'll get your opinion real quickly on that. How, like if you bought something that was unprofitable, like how does that kind of like, how do you, like what's the calculus of getting that into the acquisition price? And then like how quickly are you looking? And like
65 million on acquisition?
60 at the acquisition, they were doing 65 million and like negative 3 million of operating income or something. And then the next year they did 112 million with like 8 million of EBITDA.
I feel like they'd been around for a while. So they couldn't really justify a growth premium, right? When they were acquired.
They started in 2010, yeah.
Yeah, so it's like a fairly old brand when they were acquired. Hard to argue growth. And if they were unprofitable when they were acquired, I think that was just way too aggressive a multiple. Like again, it wasn't that big. If they're doing 200 million, sure. But if they're doing 65, I think it's kind of hard to argue the growth multiple. But I mean, good for them. The deal got done. That's great.
Yeah, no, they crushed it, and they're pretty transparent about how the deal went down too. I think it's kind of interesting to talk about. But so keeping going, 2021 basically 120 million, 2022 98 million, and this is where the wheels kind of start to fall off, right? Because late April, April 26th, 2021. Everybody knows the date for iOS 14.5.
A dark day for all of us.
It's like burned into my brain.
I think it's funny you know the exact date. I didn't know the exact date. I didn't even know if it was April. That's funny.
Yeah, April 26th. That was when it got pushed. And I don't know if you recall your experience. I know with Mad Rabbit, like it was like a pretty wicked shock right away. We did end up tripling that year though, just because we had so much momentum. But like it was kind of like a choppy, lumpy year, and it looked weird. Year over year, though, we ended up growing a lot. But it took us probably 6 or 8 months to really figure it out, like post iOS 14. And so my sense is like these guys did 120 million in 2021, probably because like iOS, they doubled from 65 to 112, and then from 112 to 119. Like they were probably going to go from 112 to 150 or something. But the wheels got kind of rocked off. So what was your experience with iOS 14.5?
Similar to what you described, like saw a pretty big jump in CAC kind of across the portfolio. I think I mentioned this before, but we had one CMO and I was like, what's the plan here? What are we going to do? And he's like, I don't know. I think we're just kind of screwed. And I was like, oh, great. Okay, you're fired. Thank you.
You're also screwed. Yeah.
I'll do this myself then. So yeah, I mean, I think it was just a matter of testing a lot of stuff very, very quickly and just finding a new playbook that works, right? And then at the same time, Meta actually did a decent job of kind of counteracting a lot of the iOS issues. I mean, I remember for a long time they
did a great job.
Yeah, like the reporting was totally foobar. Now it's actually come a long ways to where I don't even feel you really need an attribution system anymore.
I totally agree. I think attribution is kind of a fugazi. So anyway, so 98 million. So from 120 to 98 in 2022. And then 87 million in 2023.
Wow.
And then 53 million in 2024. And then sold off for $1 million. So there's a couple things at play here. Like they broke out kind of like product sales. So there's like bags and apparel and jewelry and like footwear. Right. And it looks like when they bought the company, they were like, we're going to obviously expand the product line. And so they got nothing meaningful. Like jewelry was still always over 90% of their revenue, but like they got like $5 or $10 million here or there of sort of other products. revenue for like on an annual basis, and then it seems like they just retreated immediately, and they just basically like let the thing fall off a cliff, and they still ended up losing. They downsized revenue to 53 million, and still ended up losing millions of dollars, which is why they sold it off for 1 million. So it's sad to see. I think I agree with you that I think there was like a little bit less of a product moat in these. This brand was so reliant on Meta. It's almost, I don't know.
To me, it's one of those brands that's just like basically Meta arbitrage, right? At the end of the day. It's something I would never want to own. I think it's like the only reason it works is because you have a hardcore marketing, like a founder that's just really hardcore on the marketing side and very dialed in. And it's tough to maintain those businesses if they're being acquired and being run by someone without the same incentives. It's just not going to happen, right?
And how do you know? How do you tell the difference? Like, I think anybody probably could have told you that, right? Like on the surface, but like, I hear like we raised a good amount of money with Mad Rabbit, and like the concern was always like Meta dependencies, but like this is like really dependent. Like I don't know of many brands that like are gonna like go from 120 million to zero because of an iOS change.
Like I've seen it happen a lot. Like I had a bunch of friends who had businesses doing like anywhere from 20 to 100 million that just imploded basically. Like I had one friend that I think was doing 40 or 60 million, somewhere in there, and they were running at like 30% EBITDA, and then iOS basically broke their whole CAC engine. They were lower on the AOV side. They didn't have as many kind of margin dollars to play with for CAC. And it just imploded.
The other thing that I thought was interesting that you might be able to help me understand is like why sell it for $1 million? Like it's such like a weird number to me. Like, is there anything to that?
I don't think the brand's worth much, which I know a lot of people will disagree with, but I just don't think anyone actually knows what it is outside of e-commerce. And number two, I feel like there's probably some debt attached to it, and there is probably some sort of assumption of liabilities. At the same time, just like really, if I wanted to start a Pura Vida clone tomorrow, you could do it fairly easily, right? There's no real moat. And again, I don't feel there's that much of a brand. Maybe I'm wrong, but I mean,
so you're saying that there was like $1 million, like the whole sort of quote unquote purchase price was probably more than $1 million because there was probably a bunch of debt that they had to assume, and they just paid $1 million.
Yeah, I'm assuming they assumed some sort of liability. Yeah.
Okay.
And I know a lot of big companies, especially public, they want to spin things off very, very cleanly, and they're willing to take a big discount to spin them off cleanly. So like, yeah, the liabilities were probably capped at that specific brand's level, right? If that makes sense. And they didn't flow upstream to like the entire thing. But as a public company, you don't want like one of your sub brands defaulting on debt and stuff, right? It just doesn't look good. And it's going to cause, like, honestly, it would cause way more problems for them than losing the money by spinning it off inexpensively. So if you do a really clean carve out, there's often good alpha for the acquirer because of that, because there's so many considerations for the guys that are spinning it off, right?
Yeah, and that kind of goes hand in hand with the 2022 reported operating loss of $80 million, right? And I thought you kind of framed it nicely when we were texting last night about like, so they're saying, right, that Pura Vida lost 80 million on 98 million of revenue. That's mostly non-cash though. So like there was 44 million of like goodwill impairment charge, and then 25 million of like the brand impairment charge. Goodwill impairment, like I understand. The brand impairment charge, I honestly have never seen before. So just walk our listeners sort of like through what does that mean, and like what's the incentive to do it? And to me, it's clearly like they were going to dump this thing.
Yeah, more or less is just to depreciate the value faster so you can take the tax benefit, right?
Mm-hmm. Yeah, so basically you write off 80 million. You say, hey, I bought this thing. I accrued all this value basically to my balance sheet based on like the value that I thought that it was. It actually sucks, and I'm just going to expense all of it, and I'm going to do so because now I can sell it off and I get like a certain tax shield or whatever.
Cool. Drew, have you ever heard of the Operators Pact, by the way?
I've not heard of the Operators Pact. What is that?
The Operators Pact says that if you listen to this, you're automatically bound to go to our YouTube channel and subscribe. So if you type in Finance Operators, go there, subscribe, let us know you did it. We'll say thank you. We'll shout you out wherever you want. And make sure you also subscribe on Spotify, all those places. Sorry, we can keep going. I just wanted to do that.
Okay, last thing on this is the buyer's undisclosed. Okay. How typical is that?
I'd say it's fairly normal. I mean, we're all going to find out relatively soon, anyways. Maybe they just have to do a few things first. So,
Okay.
not a huge deal.
So I have a hypothetical. So Project Aster Acquisition LLC is the name of the buyer, which is fairly anonymous, right? Do you know what the aster flower is?
No, tell me.
The aster flower is a a flower that blooms in the fall, where most flowers are dying, right? So the aster flower blooms in the fall. Typically, you would expect a flower to be dying in the fall. So it's been a symbol of like resilience or new beginnings or fresh starts. And I'm totally speculating here, but I might make a little bit of a call that like I think it could be Paul and Griffin under this Project Aster Acquisition LLC, and the Aster sort of nomenclature or title or whatever is kind of a hat tip to like redoing it over. So we will see. We will see who it ends up being, but I do think it's kind of a funny DTC legend to tell maybe that these guys are buying back Pura Vida. So
that'd be cool. That'd be cool. I'd like to see it. I think they could crush it. I mean, they figured it out the first time. They can figure it out a second time, and they would have the right incentive. So
yeah, and, selling for 100 or 130 and then getting it back for $1 million isn't such a bad deal, anyways.
No, it's a great thing. Yeah. Okay, cool. Where are we headed next? What's next here?
You're going to school us on how I cannot get Donnied by the tariffs.
Okay, cool. Let's go through this. Let me bring this up here. So everyone wants to know, how do I avoid getting destroyed by the tariffs? Your COGS are going up. It's a really bad time. Your CFO is panicking. Maybe you are too, as the founder. I guess a lot of CFOs are probably listening to this as well. Anyways, so let's go through a few tactics that can help you. Some of these will lean more towards the supply chain side. Some will lean more towards...
Can we take a step back though and just get a quick understanding of like what are the tariffs? Like tell me like what's happening, what's changing, what can I expect?
Well, it seems to change every week, but essentially the current administration immediately imposed more tariffs on China. And, by the time this releases, it'll probably have changed again. There was kind of another chunk of 20%. And then there were also random tariffs here and there on Mexico and Canada, which were lifted, put back on, lifted again. So I don't know. If you're a supply chain guy, I feel really bad for you because it feels like every weekend you have to panic and something horrible has to happen. I know our teams have not been sleeping much. I got so many texts from them a few weeks ago. And I feel like everyone's taking Trump less seriously now. But I mean, it was just terrifying initially where
terrifying.
It was like, oh, cool. Is our EBITDA going to go from delicious to not so delicious? And I know Mike mentioned this on the other podcast where he made a post about it. He said it was a huge hit for them. Like it's 8 figures, an 8-figure hit to EBITDA. So there's a lot of guys, like great operators, feeling the pain. And it's you don't want to make any huge supply chain decisions right now because you don't know if the administration is going to reverse what they're doing in 2 weeks, right?
Well, they're saying April 2nd, right?
I think so. But it's like they had all these arbitrary deadlines before that got pushed back or just completely wiped out. And it's just frustrating. Like, are you really going to go through and spend a ton of money on CapEx to build a factory in the US if you don't trust the current administration? I mean, I don't. We're not making any decisions. So
yeah. So
anyways,
COGS go up. As if your CAC wasn't already going up enough, your COGS are now going to go up.
So now everyone's getting slapped by the old COGS machine. So let's go through this. The first thing I like to do, really, at any company we get involved with, is declare a price decrease. A lot of people think this is really funny, but my thought is you get a letter all the time from a supplier saying, "Hey, we have to increase prices." Blah 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 blah. Why not do the reverse? You can definitely send out a letter that says, "Hey, we have a price decrease. The business needs to urgently reduce costs, and as a result, all future invoices will be reduced by 5%. The best person to send this is someone with like a lot of authority. So I like people that don't directly deal with the vendors. So the CFO is a great person to blame. If you're the CFO and you're listening to this, sorry, but a lot of people think CFOs are mean and cheap. So if you can have your supply chain guy send this out and then say, this came directly from the CFO, or if you don't have a CFO, blame the CEO. It tends to work really, really well. And inevitably, you'll receive some bills without the 5% deduction. When that happens, email back, just confused, and say, I mean, you saw the email. We can't do this. and usually they'll kind of settle in around like 2% or just a cost freeze for the next 24 months. Either way, it's a really big win. You'll definitely realize some sort of savings here.
How often does that work?
Every time. I'd say like every time we send this out, we at least save a really big chunk of money. It's just like, I think people take you more seriously too.
Don't you have like agreements though with these suppliers?
No. I'd say sometimes you do, but often you don't. I mean, there's nothing that stops them from doing a price increase, right? I mean, like usually you will get a price increase letter because like, oh, this material went up. I mean, there's nothing wrong with you saying my CAC went up. It probably did.
Oh, we used to do like pretty chunky commitments with our suppliers. Like we would have like 2-year agreements where it was like, I'm going to buy this much from you at this price.
Wow. Yeah, I would not sign a 2-year agreement. I'm going to text Salon right after
we got
this.
a good price break.
I'm going to text him. I'm going to jump on him and help him out with this. Okay. So next thing is don't ask for an outright price decrease. You can do it sometimes, like I just mentioned. That's fine, but don't keep asking for them because it gets kind of ridiculous at some point. What you really want to do is work on engineering a new product that's effectively a cheaper variant. So the big thing to know in Asia, there's a bit of a big man culture. You don't want to be seen. You don't want to be the guy that, say you're in a group chat or something and Drew texts you saying like, hey, give me lower prices. And you just say yes. Like it doesn't look good culturally. So what you want to do is ideally do this in person. You show up and you work on engineering a new product together, remove non-value add parts of the product, reduce sizes and packaging for better shipping, make it as lightweight as possible. And we found examples of manufacturers doing crazy things that, I mean, it's cool they do them and it's nice to have the attention to detail, but the customer just doesn't care. So for example, at our floral company, we found out the manufacturer was arranging every single pack of flowers. Like we would sell, say, a 12 pack. They're arranging them all face up, every single pack. And we're like, by the time this hits the customer, it's been jumbled around no matter what, because FedEx is shipping it. And obviously it's coming from the water to us. And then it's going from us again. And then from the distribution center we have out to the customer. So by the time it goes through all that, it's getting totally jumbled. There's no value add there. So going through and helping them find that and get rid of it can be really, really big for both of you. It doesn't cost them anything. It doesn't cost you anything. It just makes things better for the customer. Other one, specific for tariffs, is make sure your product's being correctly classified. So speak to a trade lawyer. Did you use trade lawyers much?
I don't even know what you mean by like correctly classified.
So when you import something, there's an HTS code. That HTS code is basically tells you what you're going to be taxed, like what the effective tariff is and if anything else is applicable to it.
Is that new with the tariffs?
No. HTS is really, really old. Like it's been around since I was a kid, I guess. But
interesting.
Yeah, but a lot of the times it's kind of fuzzy. So if you actually go and you try to find something, an HTS code for something that you think would be simple, there'll actually be like 4 to 10 possible HTS codes that it could be imported underneath. And it's hard to know what the exact correct HTS code is. We've seen this happen tons of times where a brand's been importing it underneath the incorrect HTS code and it costs them more. So they've been paying too much in tariffs because they used the wrong code.
Can you get that refunded or anything?
I think you can apply for some sort of drawback. I saw a post on ECF about it a long time ago. You can. The main thing though is like, can you reclassify it or can you argue for it to be classified differently? And you might actually need to make like a special appeal thing. I forget what it's called, but you have to have a trade lawyer help you with that. And I also would not just outright reclassify something without getting a trade lawyer's opinion. And I would speak to at least 2 of them because sometimes someone feels like you can push for something and you can have something reclassified. So they are kind of pricey. I mean, I'd say like a good trade lawyer is probably going to cost you $1,000+ an hour, but relative to what you're getting railed on for tariffs, it's cheap, right? It's a pretty good win. It's a solid win, and
it's an investment.
Yeah, exactly. So that to me makes total sense. It's a good place to invest. Other one is get on the plane. So culture everywhere in the world outside of nerdy businesses are in-person heavy. If you're an e-commerce guy, you're a SaaS guy, you are a nerd, and you probably don't quite realize this. But especially abroad, right? Like there really is a culture of showing up in person. Your manufacturer will trust you much more. They'll take you more seriously if you show up. And when you show up, like you'll find immediately things go much, much better. You don't get any sort of weird tension or weird issues when you're trying to negotiate back and forth. And what we like to do is we usually hire someone or we have someone on the team wherever the area is. So like, for example, we invested in an apparel company in Q3 or Q3, maybe tail into Q3. And we helped them hire someone in China. And that guy, he'd been at Adidas before, so he really knew the manufacturing side of how things worked. So when he showed up to help negotiate, things just went way smoother. Like he could call out certain things. I forget what those certain things were, but I think it was something like the stitching or something. And they just took us much more seriously and immediately gave us a discount.
Well, I think that's an interesting point because, like, I don't know, as we sort of like, I graduated college in 2019, right? I was in an office at the bank for like 8 months before COVID hit. I have essentially only I travel a good amount for work now, and I meet people in person, and I like to, and I enjoy it. But I think it's really easy to like overlook this one and just be like, yeah, like why can't we just do like a Zoom call, especially if you're trying to go to like China or something.
Yeah, exactly.
What's like your sense for how business travel and in person has evolved? And this is like a small question I want you to answer, but like, do you feel like now people kind of meet in person as much as they did before COVID, or is it still kind of pre-COVID levels? Because I don't have like a reference for it.
So you're a baby, you're very young, but I'm not too much older. It's like I'm 31, and before COVID, I would say it was definitely more common. And it was accepted as commonplace. And then I feel afterwards, there's been less of it like, oh, this is an obvious thing we need to do frequently, if that makes sense. And it's definitely
like it's almost like an advantage now.
Yeah, exactly. Which is really weird. But I think being like the only idiot that will get on a plane is actually a very, very good thing. And we've actually won a lot of investment deals that way, where we're literally the only idiots that will get on a plane and go show up and pitch someone. Because I don't know, it's just like people take you a little bit more seriously. You show up, it shows that you actually care, right? There's a certain level of care. It shows that you're investing time and it's very tangible. If you're flying out to China, the manufacturer knows that you're a serious person, you're a serious brand, and you're taking everything really seriously. If you weren't, you would show up. So,
and it means a lot too. Like, I've talked to like certain VCs that are like, they email me and I'll be like, sure, we can talk. And then we'll have a conversation and they'll be like, what if I come to Chicago next week? And I'm like, that would be cool. Like, yeah, like that, versus, yeah. So I think this is a really good one. I think that's worth kind of highlighting for sure.
Cool. And then the other thing I want to go through is when you're negotiating terms, keep in mind that say you're dealing with a Chinese-based manufacturer, they're insuring their AR using something like Sinoshare, which means like the risk isn't as big as it seems, right? So if they're giving you, let's say, net terms on like $1 million worth of orders, they're offloading most of that risk through Sinoshare. And most countries, I'd say like pretty much all countries, have heavily subsidized lending and insurance from their national export bank. Like, for example, I know Canada offers it. I think the US does too. But not many of us are actual exporters where we're manufacturing something, say, stateside or in Canada, and then we're exporting it. So we're not really eligible for that financing. But if you were, you would have really, really low cost of capital, like exponentially lower than what market would be, sometimes by like half. And I know China right now, I forget what the exact rate is, but it's very, very low. It's heavily subsidized. They want to encourage more manufacturing. They're not doing well. So they're subsidizing it more than ever. And again, they're holding things on their cost basis, right? At their cost basis, not yours. Like you're paying a markup. Obviously, that's how they make money. There's margin. So their cost basis for holding the inventory is much lower. And then on top of that, they're getting access to really cheap lending. So keeping it on their books is so much cheaper for everyone, really. The main thing is showing them how they're going to make more money. So you want to ensure that they understand, like, if we have these net terms, we can grow faster. We can get more aggressive on the marketing side. And yeah, sure, like things might not go to plan, but that's not our goal. And this just gives us kind of more dollars to play with. And you guys can actually make exponentially more money here in a year versus being more conservative. The other thing you can push for too is just holding more raw materials or more finished goods on hand. And that effectively is the same thing, right? If you cut a lead time for manufacturing down from 6 weeks to 3 weeks, it helps you a lot on the forecasting side. You don't need to be as precise, et cetera. And all that stuff adds up tremendously, right?
Yeah, and this kind of comes back to what I was saying. Like, I think the way that we set up our supply chain with Mad Rabbit was maybe fairly unique. But like we would basically have like multi-year agreements with our preferred, like our primary supplier. We had several, but and we would tell them like, hey, like you can rock this. Like, you can take this PO to the bank. Like, I'm gonna give you a 2-year, 8-figure PO of like, this is what I'm gonna buy from you. This is when I'm gonna buy it, and this is how much I'm gonna pay for it. And then he was not exactly sophisticated from like a financing perspective, and so I actually like helped him like take that paper to the bank and like get financing to hold it for us. And so we were able to get like we were able to get the price break of like the scale right through the raw materials and whatever else. But then we were also able to get the float because we knew that he had, he was good and he was happy to kind of hold it for us there. So there's a million and one different ways you get creative with that kind of stuff.
Yeah, exactly. And really, the more of this risk you can transfer to your manufacturer, the better it is for you because you can take more risk on the marketing side. Like the goal is to offload back end risk and front load it on the marketing side. Like really, the more CAC dollars you have to play with, the better. So that's the way we look at it, at least. And obviously, it's much better to have an unsecured vendor like a manufacturer than it is to have an actual loan on your books where there's security. So more operating flexibility, lower costs, and you can take more risk on the front end.
Yeah, 100%.
And like you said, sometimes you do have to work with the manufacturer to help them get sorted. We literally had to have someone on our team with a very small supplier that we had that made a critical, we have bill of materials, obviously, and they were producing a critical material for us that goes into a larger product, but they were very small. So we had to have our person who was in China help them get set up with Sinosure. It was very fun. Yeah. Similar to what you said. Other one I want to go through is just literally 10xing your sourcing. So I'd say very rarely do we talk to companies that are sourcing enough. So you should have at least 3 very qualified factories for any major component. And to get there, you probably need to have initial discussions with 40 to 50. I also people who are like, yeah, I pinged 10 manufacturers. This is where I ended up. It's like, no.
Is this for like when you're manufacturing your own products?
Yeah. Oh, no. Not just, well, that's like your bill of materials if you're manufacturing your own. But even if you're sourcing from a third-party manufacturer that's doing everything for you, you still need to speak to really like 40 or 50, especially if you're in a vertical where there's tons of manufacturers. So for example, apparel, or something like even luggage. There's just so many manufacturers out there that you can speak to. You should be going through the ringer for sourcing. Don't get lazy. It's just such a huge lever for the business, right? I mean, you look at COGS as a percentage of revenue. Do you know what's normal like across Iris that you guys see? Let's say for like hard goods, I don't like exclude beauty.
Oh, excluding beauty. I mean, like sub 50%. Like it could be 45, 50, 55 at the high end, 45, probably more average.
Yeah. So just a huge chunk, right? I mean, it's kind of something, it's just so weird to get lazy about it. And I know it's not fun, right? My co-founder he used to take a caffeine pill at like 10 p.m. and just source from 10 p.m. to 2 a.m. When we were working on one specific brand. It was disgusting. But
you can only change suppliers so much.
You could do it a lot. I think a lot more than people realize, especially if it's something like apparel,
how many times a year? How many times a year could you possibly change manufacturers?
So like one of our brands will have gone from using, well, sometimes it's in-house, then we're moving it offshore or vice versa. But like apparel brand we're doing right now, we'll have moved 2 or 3 times. And just keep in mind, if you're dealing with a large catalog with different product lines with different manufacturers, you do it a lot, right?
Well, beauty, like the thing is, if you have any special formulation, it takes a quarter just to do sort of reverse engineering to like get another factory up to speed. So yeah, maybe for some other categories it's easier, but like we would have had a really hard time just like hopping around suppliers.
No, it's harder in beauty. And also the fill is not that expensive. The packaging is your bigger lever there. So, I mean, the fill has always been very negligible whenever we do a beauty deal. Packaging's where we really tend to hammer in and save money. So
Mad Rabbit has aluminum tubes, and so
that's cool.
Yeah, well, for a couple of the products, and so like the crimping of like the top of the tube, there's like 3 people in the country that like have that machine or something. So we ended up just buying one to like send to people to like be able to use to fill our stuff. But it's weird like constraints like that like, you know, we had probably 4 or 5 suppliers, but like one primary one for forever.
Interesting. Yeah. I'd say for most brands, again, if you're doing something like apparel where you're really wide skewed, there's tons and tons of t-shirt manufacturers across a ton of different countries. You want to speak to as many suppliers as possible. And ideally, you do a visit. So what we'll do is we'll line it up with something like Canton Fair, and we'll make sure we see as many manufacturers as possible there. Again, the good thing about showing up to things like trade shows is your manufacturers know you're serious. They know that you're not someone who isn't actively sourcing and will not replace them if they don't perform to the quality level that you want at the price you want. If they know that you're not actively sourcing, they don't really care. They're not incentivized. And if you try to negotiate, they'll just laugh at you. So we found that's just something we have to do, is show up to things like trade shows. Next, I want to go through giving your suppliers a demand forecast. So don't be one of these guys who just places a PO, shows up out of the blue, places a PO and says, great, make it for me within 6 weeks. That is very bad. It's not, you need to treat them more like a partner and you need to give them an updated demand forecast, ideally every month. Again, it depends on what percentage of your business they are, but we essentially have our teams push an update out to our suppliers every month or every quarter, just to keep them abreast of what's going on. Like, hey, it looks like we're going to be soft, or it looks like we're going to be above target, just so you guys know. And we're not going to change the PO, but just so you guys know, the one after this PO, or maybe in 2 more POs, it might change quite a bit. So that's been really big for us. I think they appreciate it quite a bit because not many brands do a good job of keeping them up to date.
I mean, you could talk for a long time about that. It kind of comes into the whole forecasting and having, your sort of broader financial plan aligned with your demand plan, aligned with your cash flow model. Like it's all sort of interconnected. And that's obviously, a big part of what we do. But like if you like don't send them a demand plan and they're kind of just like operating in the dark, like they're probably like going to be less willing to give you, terms or breaks or anything else too, because like they're not totally confident in what's going on. So my 2 favorite were the get on the plane and then the demand plan with the manufacturer. I think those are 2 really like low hanging fruit.
I have more for you here, but first, Drew, do you like drugs?
No, I never do drugs. Of course not.
That's good, because you know what a drug is for brands? Discounts. Discounts are a drug, and fondue is the rehab that they need. So if you're burning dollars because of coupons, that's bad. Brands lose up to 20% of revenue to pointless, non-incremental discounting. Fondue, our beautiful sponsor, places coupons with cash back and supercharges those margins. So you'll keep more of what you earn and you'll stop training your customer to wait for a code. It's been tested. It works. The guys from Ridge have used it. I think True Classic, and it's cheap, fast, and easy to run a test with. Again, there's huge potential left. It's cheap and fast to run. Why not test it? Doesn't really hurt you. Head over to getfondue.com and tell them Finance Operators sent you.
Especially in an environment where tariffs are, already causing increases in COGS. Like it's such a no-brainer way to just like try to get some, expansion out of a tumultuous time. I don't see why you wouldn't have tried it at this point. Yeah, it's literally free money. You hate money if you don't use fondue.
Exactly. So head over to getfondue.com, let them know we sent you, and sign up. Cool. The other one I just wanted to rip through really quick is sometimes aligning your POs and when you place them can get you really big discounts by piggybacking off of larger brands. So this tends to work well if you're selling something that's really commoditized. A good example is we have one brand that sells a lot of eucalyptus, and our purchase orders were essentially synced with Michael's and Hobby Lobby. Or maybe I think it was just Hobby Lobby. Yeah. Our purchase orders were synced with Hobby Lobby. And because of that, we got large discounts. Obviously, there's a growing season there. Obviously, something like eucalyptus is really commoditized. You can't just grow it too differently. I mean, it's a plant at the end of the day. So that can get you really chunky discounts. I would just make sure you ask your vendor about stuff like that, because it will not pop up in their brain to ask you about doing that. And you can sometimes get a really good discount because it's effectively like they're producing in bulk for you, even if you're a smaller customer. I mean, obviously, you're probably not Hobby Lobby. So that's a really big win. Last one I want to go through is using contract to generate a sense of fairness. So you mentioned you guys did use a lot of contracts at Mad Rabbit?
We almost never place like a one-off PO.
Right. And you guys were largely US-based, US sourcing. Obviously, the fill just makes more sense in the US.
We had a lot of components that came internationally. Like I think the shea butter comes from Peru, cool. And then the aluminum comes from China. But to be totally honest, like our manufacturer, like he crushed it on sourcing for us. Like I was the COO, and like I wouldn't say that like sourcing is like one of my core competencies, because like he handled most of it.
Cool, that's great. But yeah, I mean, internationally, if you're sourcing using a contract, you're not going to enforce it unless you're doing like 9 or 10 figures or something. You're just not going to show up to Chinese court and litigate something. Hopefully not. Just such a bad use of time. Even if it's
Get on a plane. Go to Chinese court and litigate.
Yeah, good luck. Let me know how it goes. So the real reason you want them is to generate a sense of fairness. I highly recommend using a carrot. Don't use the stick. Don't beat them up. If you don't want to keep punishing for something because you're just going to end up lower quality and even later and not on time. What you want to do is something like give them a bonus if they're on time and meet a certain quality threshold, and spell everything out. Like, hey, if this doesn't happen by X, here's what's going to happen. If it does happen by then, here's what's going to happen. The goal is just to show them and have something to refer back to generate a sense of fairness. And the really cool thing is now you can quickly whip it up in ChatGPT with whatever specifications you want. You don't need a lawyer for this. I really would not use a lawyer. It's kind of stupid. Again, it's never going to be litigated unless you want to show up to Chinese court, which is really stupid. And your lawyer is not going to help you write something that you can actually litigate in Chinese court. So make sure you go through, make this, just use something like ChatGPT. What you want to do really is just cover as many scenarios as you can and then translate it. I mean, the cool thing is you can get really good quality translation. I use it all the time for Spanish because we have one company that's operating out of Mexico. And we also use it all the time for stuff like obviously Chinese and then in India as well with Hindi. Like my Hindi is kind of okay, but definitely not good enough to be writing business contracts. So it's worked really well for us. I highly recommend doing that. And it's just, again, a mutual document you guys can refer back to and say, oh, this is fair or, oh, this is not fair. And that's really it. That should help you hammer down those costs. All right, Drew, let's cover 23andMe. You did a bunch of deep research. You know what's going on here. You know exactly who's going to sell everyone's genetic information, who's going to buy it, what's going on, what happened.
Basically, they filed for bankruptcy, and it's Chapter 11. So really quickly, I want to kick it to you to describe the difference between like Chapter 7 and Chapter 11 and any other chapters. I actually don't know that much about this, but I assume that you do.
Yeah. So Chapter 11's restructuring. The other one's liquidation. The running joke in restructuring is that a Chapter 22 exists. It doesn't. If you ever see a Chapter 22 or Chapter 33, the joke there is that they just filed Chapter 11 very close together twice. So you'll see someone go through restructuring and then they might file again in 2 or 3 years. And like the joke is like, oh, they had to file Chapter 22. So if you ever see that, there's a little insider, funny little joke for you. That's where they're at. So I guess
hilarious.
They're restructuring. Yeah. Can you walk us through the history of the company, what they do, what happened? And they're a really interesting tech-driven D2C brand, really, at the end of the day.
Yeah. So the reason I think it's interesting to talk about is because 23andMe is a direct-to-consumer brand. That's what it is. Like, it's been dressed up sort of as like this like biotechy like services whatever type thing. But at the end of the day, they were a highly successful pioneer of the direct-to-consumer business model, and I don't think people think of them.
Have you used it before?
I have a one in my drawer that I haven't used yet.
I really wanted to use it, but I went to go use the website like a year ago, and it was really confusing. I couldn't figure out how I just purchased a straight up test without a subscription. I don't know if it's still like that, but it's really bad that the e-commerce guy can't figure it out. And I thought I was just like huffing paint or something. I'm like, why am I having so much difficulty with this? I probably spent 5 minutes on the website, 6 minutes, just trying to figure out how I'm like, I just want to go there, order a test, get the test done, send it in and get my results. I don't want to subscribe to anything. They're just these weird subscription options. So
well, ultimately, it seems like that didn't actually work out for them on the subscription side of things, because what it comes down to is just, you don't need to buy one of these things more than once.
No.
And despite the fact that they innovate...
Did my DNA change? Is my ancestry different now? Am I suddenly half Peruvian?
They should have come up with like some other stuff. Like I don't know, like Brian Johnson seems to be doing all sorts of different tests. Like I'm sure there's like different tests that they could do, but essentially they file for Chapter 11 bankruptcy. The CEO and founder, Anne Wojcicki, has already declared that she will be making a bid to buy it out of bankruptcy. So like they started in 2006 or 7, and they invented this like DNA testing kit, which was incredibly novel at the time. And then they go and they have this is unverified, but I think this is the all-time fundraising run by a D2C brand. So $9 million Series A from Google and NEA. Are you familiar with NEA?
Yeah, I am. They're pretty big.
They're like a blue chip tier 1 fund. Mm-hmm. So like you have Google Ventures and NEA do the $9 million Series A. Those guys come back to double down for a $28 million Series B 2 years later. They also got that 2008 Time like Invention of the Year, which was kind of interesting. And then the $31 million Series C comes in 2011. So it's Google again. Now Johnson & Johnson is getting involved because, 23andMe is a biotech company and not a direct-to-consumer brand. 2012, there's $58 million in Series D. And then 2015, Fidelity comes in for $115 million Series E. So can you just explain to us really quickly, like the significance of like when a Fidelity or a Franklin Templeton like comes in, like what does that like generally signal?
That is like about as blue chip as you can get. And they believe that you are essentially going to be very profitable and kind of a healthy growth stock to own. It's like you're essentially going to become something like, I'm not saying you're going to become Google, but you're going to become something as blue chip as Google one day, maybe. Just a healthy cash flowing corporation that they can safely invest in. And those guys manage a lot of retirement funds. So, I mean, really all investors do, but they do more than anyone. And it's really, you can't get any more blue chip, can you?
Yeah. Yeah. It's basically, it's usually like the pre-IPO round. So it's like, this company's going to make it. We are, accelerating them into the public market. And if that wasn't enough, 2017, $250 million Series F from Altimeter, which is as blue chip as Fidelity, maybe in some cases. And like we're like halfway done here. Okay, so $300 million in Series F from GSK, which is a big biotech company. The reason that GSK invested $300 million was because they were going to use the data to produce like novel drug concepts or whatever. It didn't work. It never helped. And then Sequoia, for some reason, he's in his Series F at $82.5 million. I don't really know why that. I thought that one was a little bit weird. And then in 2020,
you know what? Sequoia had like their whole. I think around then, Sequoia had their whole thing about they had like a specific method for running an IPO, and they were really public about it and pushing for how they did it to reduce cost. I forget what it is. Do you remember that?
Like a direct listing?
Yeah. I think that's around when they were pushing it. Maybe that's why they got involved to help them execute.
Maybe, yeah. Like Spotify did a direct listing famously, and then obviously like the SPACs came in. So,
yep. And actually, you should walk through the direct listing thing. It's actually really interesting. It's good color for everyone.
I don't know it well enough to talk to teach somebody about it. I mean, it's basically just like you sell, you do it. Yeah, you say it.
Well, normally you would like pre-sell some of your company before you go public, and then the bank gets margin on that, and they essentially help you resell the stock, if that makes sense. And think of it as inventory. Yeah, you can think of it as inventory. With a direct listing, you skip all that, and bankers really don't like it. And I think the exchanges kind of don't like it either because they feel like it's not as trustable or something. But Sequoia has really good write-ups on it. And sorry, that kind of is a tangent, but it's interesting. It's something to Google and it's fun read.
Yeah, it got like popular kind of like there's like SPACs, there's direct listings, there's typical IPOs. I only ever did IPO. Well, obviously, as a banker, I was only ever on like actual like typical IPOs.
Cool.
So they go public at a $3.5 billion valuation. And then they basically just crater. And I think it's a really, well, not immediately. They grew for a couple of years after. And then 2023, there was a data breach where 7 million consumers lost all their information.
Wow.
And I don't know, do you know anything about like cybersecurity? I feel like you would for some reason.
Honestly, no. One time we had a portfolio company that got hacked and lost like 200 grand or something crazy. But no, I'm not super familiar.
So the way that these hackers did this, it's called a credential stuffing attack. And what they do is they basically go, I don't know if it's the dark web or where, but like they get all these different, usernames and passwords from other places. And then they just basically cram them into 23andMe until one works. People that are using like the same username and password for multiple things. So apparently that worked for 7 million people. And then, from there, it was just the brand got completely tarnished. And I think this story really sort of underscores the importance of trust. And like, you grew revenue in 11% in 2022 after your $3.5 billion IPO, and then you grew 9% in 2023. So like the company's like still growing. And then in 2024, your revenue shrinks 26%.
Wow.
And then for the trailing 12 months, it's actually even shrunk beyond that 5%. Meanwhile,
I think everyone quit too, by the way. I think like the whole C-level suite essentially quit.
Yeah, I wouldn't be surprised. Like it's hard to kind of stamp your name on that one. And so revenue is like falling off a cliff, basically driven by this whole, scandal. Meanwhile, like the R&D that they were doing, because they're a biotech company or something, they were spending well over 100% of their revenue on G&A plus R&D, and so
Crazy.
basically, long story short, the losses just got out of control, and they raised so much money, but like their cumulative loss right now since going public is like $1.6 billion. And so the question that everybody's asking, and
did you say question?
Yeah, question.
I have a question for you. Has anyone ever said that they've seen your back end? Because they said that to me. Because someone said that to me. They said it's ugly. We need to get in there to fix a few things. And I was like, what? Excuse me? Well, here's the deal. Luckily, they were talking about my company, not me. If you're like me and your ops are kind of duct taped together, or they have been duct taped together at some point, you're using Google Sheets, you have a bunch of Slack threads everywhere. It's getting disgusting. It's getting overwhelming. And you're still running vibes-based operations. You're waiting 22 weeks for a horrible ERP to go live. You're not ready for scale. Things are not going well. And you need Fulfill, our sponsor. They're amazing. We use them at one company. We pay them six figures. They crush it for us. We run a messy multi-country company with manufacturing across multiple continents and almost 200 employees. We switched to Fulfill. It works. It helps. It doesn't suck. Go to fulfill.io. Tell them finance operators sent you. They'll treat you like someone who actually knows what a BOM is, and they will crush it for you. So they raised 1.6 billion. They burned 1.6 billion.
Oh, so the cumulative loss is 1.6 billion. Like they raised a lot, but like that's a lot of money to lose. And so everyone's kind of asking this question, right? Because you have this like 23andMe database, and you are now in Chapter 11 bankruptcy. So the question that everybody's asking is, what is going to happen to the data? So like, do you think like, I believe in their terms of service, like they are allowed to like transfer the ownership of this data however they really please. What do you think? Do you think that's gonna happen? And if so, like, what are the concerns on that?
Honestly, I have no idea. I would assume it happens. If it's not restricted, it'll probably happen. It seems like something that's valuable. Yeah, I don't know. That's where I am. I don't have any super strong opinion. I'm curious to see how it plays out. Obviously, it sets a bit of a precedent. The only other guy who's doing this, I think Ancestry does, right? Ancestry.com.
Yeah. Have you ever seen a company that was like in bankruptcy, but like had something valuable that they like weren't willing to like sell off to resolve it? Or like, is that even like an option? Like, could they hold on to this if they wanted to?
Well, the deals we do are relatively small, so like they don't get super, super contested. You don't really see that until something's doing over like 250, 500 million. But I've read about stuff like that where just all sorts of wild stuff goes down during the restructuring, where you have people putting in crazy credit bids and stuff and try to fight over a very specific asset. Maybe strategic enters, starts fighting over it. So I don't know. We'll see. Maybe things will get really, really interesting and you'll have a few strategics fighting over it.
Yeah, my bet would be that like it just gets sold off to some like GSK, for example. Like it's a good idea in theory to like to use all this data to like try to create drugs. Like I don't know why they didn't really pull it off the first time, but I think they're probably just gonna sell everybody's data.
You know, there's a gene that makes a certain herbs taste like dirt to you.
Like this, like people that don't like cilantro or whatever.
Yeah. So maybe you could identify the cilantro lovers and sell them cilantro. There you go.
And then we can start a D2C cilantro brand. Yeah.
$100 billion idea. There you go. You heard it here first.
So yeah, I mean that's kind of the gist of the story. I think the takeaways for me are just like trust is everything. And if you fracture that, like even a high flying, innovative, fidelity backed biotech direct to consumer powerhouse, is kind of brought to its knees in a matter of quarters, just because I guess they didn't take the proper precautions to kind of protect that data. So I don't know that many of our listeners have the same level of sensitivity around the information that they're collecting, but I do think it's one of those sort of key risks to kind of look out for.
We actually had a company that we were looking at like 3-4 years ago that had a hack with their payment processing page or something, and a bunch of, I don't know if credit card information was stolen. They weren't on Shopify. It was something else. It was like a custom setup. And I think a bunch of information got stolen and they had to publish a notice or something and all this crazy stuff. And it put them in a really bad position.
that would do that. Yeah.
Yep. So be careful. Luckily, I mean, a lot of platforms make it pretty easy now, but back in the day, stuff was pretty wild. All right. That was a great episode. Thank you so much for listening. Thank you to our sponsors, Fulfill and Fondue. And more importantly, don't forget about the Operators Pact. Head over to YouTube, subscribe. If you're on Spotify, subscribe wherever you are. Apple, make sure you subscribe. Tell us that you did it. We'll retweet it, especially Trio. He loves retweeting things.
And don't forget our third sponsor, Iris, my company. We are a FP&A software for the consumer sector. We help brands really get better visibility and better planning into their businesses. And ChatGPT may have launched the image generation, which is actually pretty cool. And I think that's gonna probably not help a lot of people. But for now, your 3-statement modeling and your cash flow modeling is safe in the hands of Iris. So give us a whirl or book a demo on our website, irisfinance.co.
You heard it here first. No generating hentai.